I know you may think this is a surprise, but yes, this is me live, back in the flesh. It's been a little minute. Time's been almost a little busy, but as y'all can already see, what pulled me out of retirement was this book that I read. I read it to Mr. Barry Ritholtz, and he was the most nonchalant person I ever met. You know, usually you meet people in the financial industry, they always an expert on something. Everybody knows something. They know what's about to happen. They're going to predict something. And I just said, hey, Mr. Ritholtz, I've seen him everywhere. You've known him. You've seen him on TV, Bloomberg, you name it, you know, all over the media. And I said, hey, what is your advice? What do you think we're at in the market right now? What do you think is going to happen? And he gave me a answer that I had heard in a long time. He said, I don't know. I said, what do you think about gold, crypto? I don't know. Maybe you might. I don't know. Yeah, we got an all-time, but what does that mean? I went back and he told me he had a book. And I said, you know what? I'm going to buy this book and I'm going to read it. You know, it's a pretty thick book too. And y'all know I'm not that smart of a guy, so it took me a little while to read it. But I got through the book, and this book held my attention and was the best book of 2025. I haven't ranked it all the way yet, but it was my best book of 2025. So I reached out to him, and I have him on today, and we're going to have a nice conversation of how not to invest, because knowing not what to do helps you to tell you what to do. So without further ado, ladies and gentlemen, let me sit back and use this little sound effect here with a nice little drum roll. Clap. Welcome, Mr. Barry Ritholtz. How you doing here, Barry?
I love that intro. Thank you so much. I remember that conversation.
Mm-hmm.
I don't know if I would say it was nonchalant.
Yeah.
But you said, hey, where's crypto going? I don't know. How do I know?
I was like, the market at all-time high. Should we be selling? You like, I don't know. We had 400 the last time.
Well, the one thing I do remember saying is whenever anyone asks me about all-time highs, my answer is always the same. All-time highs are bullish. When you get all-time highs, you tend to get more all-time highs. And sure, maybe that very last one, you can think of March 2000. I think from 82 to 2000, 1982 to 2000, and it's in one of the blog posts I did, something like 583 all-time highs. So if you want to guess that this is the last one, hey, man, the odds are really against you getting that 1 in 500. And if you go back to the 1950s, there's something like 3,000 all-time highs. It's bonkers.
Now, I wanted to say something about your book. It breaks down a lot of myths. It makes you feel terrible about everything that you thought you knew, that you read. We all went to the same financial school. We pretty much all read the same blog notes. We all heard the same thing. So that's what caught my attention with this book. Now, one thing I got to say, the first couple chapters, it was tearing down all the myths so bad. So I was like, well, what am I going to do? You're taking out everything that I don't know. So one thing I want to get into is we always hear this happens all the time. The next big crash or recession is always coming. We hear this on the news right now. People are saying, hey, the last 3 years, we've had strong markets. We're due to a pullback. We're due to a crash. Look at the geopolitical landscape. What do you say to that when people talk about the next big crash? We're hitting all-time highs. What do you have to say about that?
So I'll talk both generally and then I'll talk about today specifically. So generally, it's very useful to understand that we are very much geared to see negativity. We're geared to see threats. Think about what it was like when, 100,000 years ago, the person who reacted fastest to whatever that thing was in the tall grass, hey, most of the time it's nothing. But if it turned out to be something dangerous, the person who didn't react, that person's out of the gene pool. They're done. So we are just wired to see existential threat. That is why risk aversion exists. We feel the pleasure of gains half as much as we feel the pain of losses, or said the other way around, we feel losses twice as intensely as we feel the upside of gains. And it would make sense because, hey, if something bad happens and you don't react to avoid it, you're probably not passing those genes along. And so the people who were like, had pattern recognition were very paranoid. So that's the general thing. And that's why the bearish argument always is so compelling. Always is they sound smarter, and you just are so engaged with that. Morgan Housel, who wrote the foreword to this book, and really is the guy who was nagging me to do it for 5 years. He has one of his chapters in his book tells about the Wright brothers at Kitty Hawk. Think about air travel, just changed the world. Nobody paid attention to it for 15 years. It wasn't in a major newspaper for like a dozen years. So we're wired to see negativity. We tend to imagine that our own personal experience is the same thing as what actually drives the economy or the market. There's a chapter in the book that talks about, clients went crazy during the pandemic. I don't understand. This place closed and this local restaurant shut and this retail store shut and these hotel, like all these companies are going out of business. How is the market going higher? And when you do the math, you realize, oh, wait, the stock market is market cap weighted, and Apple and Microsoft, and this is before NVIDIA blew up, but Amazon and Walmart are doing great. The fact that your local bagel shop or your local pizza place went out of business isn't reflected in the stock market. So you always have to look at the math. You always have to look at the data that underlies all these things. And you have to have a realistic perspective. I spend a lot of the beginning of the book talking about how nobody knows anything.
Yeah, that's
I love that Capitol Records wouldn't put the Beatles on in America, at least not until Ed Sullivan booked them. They had 5 #1 hits in the UK. Couldn't get anything done here. And then you talk about all the various things that people think are going to happen. Just look at Wall Street for the past 5 years. Been a recession forecast we had a short recession during the pandemic, then a huge fiscal stimulus. But a recession forecast, and we forgot already. 2022 is going to be a recession. Oh, wait, now 2023 is going to be a recession. No, 2024 is going to be a recession. We really don't understand how many variables there are, how we don't know what's going to happen. There's such a range of outcomes, and we have to think a little more probabilistically rather than, pretend we know what's coming next.
And I think you mentioned that in the book about mankind, right? Like it's in our heads to see danger, and this is like you talked about the gene pool, right? So you always see the next big crash is coming. And I tell people, if you are a meteorologist and you predict the rain, it's going to rain one day. You're going to be right someday, and which leads me to my next question, my next talking point, of how you have bull and bear market geniuses. So when we're in this bull market, you see a bunch of geniuses arise. Everybody's a genius. But when that bear, you talk about how these prophets will appear. You will have the gold prophet appear, the silver prophet appear, the person like, hey, I told you, I've been warning you for this for years. And there, even back in 2008, you yourself, you was one of those guys that predicted that crash coming and picking that peak and valley. What do you have to say about the bull and bear market geniuses out there?
Sure. So many different things to go over with this. So first of all, the old joke is never confuse a bull market with genius, because when everything's going up, anybody who's long looks like they know what's happening. And then when you look at the crashes and the prophets of doom and all the Armageddonists and the people who are always forecasting catastrophes, they get it right because they're a broken clock, and even a broken clock is right twice a day. Some of the people who forecast the 08-09 great financial crisis had been forecasting a market crash like every year for 10 years. So the fact that eventually they got it right doesn't count. My favorite example of that, Fed Chair Alan Greenspan famously gave a speech on the irrational exuberance in 1996, and especially in technology and telecom. And not only was he early in December 96, the market didn't top till March 2000. But if you listened to him and sold, you missed the NASDAQ tripling over the next 4 years. It never got back down to the level where he was warning. The person who sold and then bought back after the crash was worse off than the person who just wrote it out.
Wow.
And, again, back to the math. We know you're going to get 2 or 3, 5% pullbacks every year. We know a 10% pullback happens 2 out of every 3 years. We know a 20% pullback happens once every 3 years. And so if you're not prepared to suffer the ups and downs in the market, maybe equities aren't for you. None of this is forecast. Hey, here's the past 100 years. How often do we see it down 5, down 10, down 15, down 20? It happens on a regular basis. And that's just, sometimes it's institutions making bets. Sometimes they're right. Sometimes they're wrong. Sometimes it's just the crowd kind of panicking. You mentioned gold and silver. Today, it's all about copper. Copper is going, straight up. It's funny. You flip on the TV, you put on Bloomberg or CNBC. Everybody has this incredibly rational explanation for what's happening. But if they really knew, they should have told me yesterday. Hey, telling me copper is up, 30% today doesn't help my portfolio. You have to say copper's going up tomorrow, and here's why. And of course, that doesn't happen.
It doesn't. Now, it's very phenomenal that you say that. I want to get your take on this. Would you rather be right in the bull market or to be right for the bear market? Meaning that when the bull market is here, you're overperforming, but when you're underperforming bears but overperforming bulls. Would you rather be that person, or would you rather be the other way around?
So there's a chart in the book called "There's Always a Reason to Sell."
Yeah,
and there's actually 2 of them. There's one that goes back to the financial crisis, and there's been a reason to sell every year since then. And there's one that goes back to like 1926. And so, we've done the math, we've crunched the numbers, and we've found out that if you had perfect foresight and you could sell at the top and buy at the bottom, but that's all you could do, versus dollar cost averaging along the way, the dollar cost average wildly outperforms the guy with the perfect timing. So I would rather be, the person that is betting on the ingenuity of human beings and corporate America to continue to grow profits, to continue to grow revenue. And that means sometimes you're long equities when they're down 20, 30, 40%. From the peak in October 07 to the bottom in March 09, the S&P 500 fell 56%. And I remember going on TV the day before and said, I don't know when the bottom is, but I can't recall U.S. markets in the modern era down 50% is not a great entry point. And that was pretty much, that was pretty much the low. You could ask me the same question a month before, a month after, I would have given you the same answer. Just coming back from vacation. I looked at everything, was as negative as it got. Hey, maybe I'm early, maybe I'm late, but down 50%. Anytime you see U.S. markets cut in half, now it may take a couple of months. Go back to 1929, down 56%. You still fell much further from there, but a few years later, you looked like a genius.
Now, I got to ask you this question because you're a little bit more seasoned than myself and my audience, right? In 08, you were around in 08. What was life like in 08? Because I spent the past 2 weeks watching old news articles, watching 60 Minute clips, news clips, financial clips, and I watched the commentary leading up to, during that 08 crisis when people was losing their homes. What was it like? Because I know this would happen again. What was it like to be in the industry at that time?
I don't know if we're going to get the exact same thing of 08, 09. Like if you look at the tech and telecom sector in 2000, right, when the dot-coms imploded, the NASDAQ fell like 82, 83%. Like imagine 4 of every $5 gets evaporated. And a lot of those companies disappeared. They went to zero. pets.com and all that sort of stuff. Metro Media Fiber, just a whole run. 08, 09 was broader, wider. It was the dot-coms didn't impact the economy. It was a mild recession from March till October of 01. It wasn't like, man, like I had an email list of about 10,000 people that went out almost daily, and I was getting like 100 bounces a day and we would clean up the list of people who they're no longer working at this firm. Like a lot of people were losing their job. It was very, very bloody, very, very scary for the people that failed to recognize the increased risk of what was happening. I don't pretend I knew it was going to happen, but my mom was a real estate agent, and so I probably tracked housing and mortgages more than the average person on Wall Street did in 2000. And I was putting stuff up on the blog every day. Hey, this chart is kind of confusing. Here's the relationship between housing and income for 100 years, and then suddenly it's straight up. Or here's the difference between renting and buying, and then all of a sudden, 3 orders of magnitude beyond normal, 3 standard deviations away from normal. And so I was talking about subprime. I was talking about real estate issues, and I just for the sake of doing a little wargaming. Hey, Reinhardt and Rogoff put out a study. They looked at 5 financial crises and said if in a leverage-based crisis, we tend to see housing fall 30% or more. So it was US 29, Helsinki, Japan, Mexico. I never remember what the 5th one is. And so I said, let's just spitball. What happens if if real estate falls 30%? What does that do to the profits of the 30 companies in the Dow? And so I wrote this piece for the street.com, and it was really back of the envelope calculation. I came up with a number 6,800. And nobody wanted to talk about the increased risk or housing and the impact on lending and construction and all these things and employment. They just wanted to talk about the number, which people were. And so for a year, I was the GOAT, in the bad way, not the Michael Jordan GOAT, but in the like, oh, this guy doesn't know what he's talking about. And then, and in 08, I was at an institutional firm. Not only were we long nothing starting in 08, but we were short Lehman, we were short AIG, we were short CIT. We really had been writing about how much risk there was in the market. And again, not like, I don't want to say, hey, I called this because I'm not a big forecaster, but it's, hey, people aren't paying attention to this. I remember going on Kudlow, and he just torched me on the Business Week forecast. It's like, here's everybody, and you're all the way down here. Look, you're at the bottom. And I'm like, listen, I don't do forecasts, but nobody seems to be talking about these things. I've been writing about this for 2 years. The Bear Stearns wobble with their hedge funds was the first warning. I think we're underestimating the risk in the market, and that's what I'm trying to get people to pay attention to.
Now,
it was unlike anything. So the reason I tell you that is, I would come into the office, the market would be down 500 points. It'd be down 3 or 4%. I'd fire up my Bloomberg terminal and start playing Tom Petty's Free Falling. And one of the bosses in the firm would come in and say, dude, I know you're on the right side of this, but there's blood in the streets. People are getting fired. You got to chill. And my answer was, hey, I was the guy that was the putz for a year.
Yeah.
I'm allowed to spike the football a little bit because I was the guy, oh, this idiot, he doesn't know what the hell he's talking about.
Now I want to get into this too, right? It's a part you made in the book, which is pretty funny, and that's why as I matured over time, I'm 41 today, but starting out 10 years ago.
Happy birthday!
Oh, not as of actually today, but as today as we're speaking, but 10, 12 years ago, I used to pick stocks, talk about penny stocks, this, that, try to figure out, when you kind of finding your way. But now at 41, I really resonated with this part of the book when you said, pick the right stock by buying them all, and it was a very good point that you said over the last 3 decades, 1.3% of stocks have carried the entire market. And when I saw that, I said, wow, I did, come to think about that. So you're like, what is the likelihood you're going to be able to pick the right stock now and hold on to it long enough, and things like that. So how do you feel about that? Pick the right stock by picking them all.
So that's based on research by Henry Bessenbinder of Arizona State University. And depending on where you look, sometimes it's 1.5%, 2%. If you're looking global, if you're looking US, developed ex-US, it really depends on which set of market data you're looking at. But this was an accidental discovery because he was comparing bonds with stocks. And what he ended up finding was, some stocks are up a little bit, some stocks are down a little bit, some stocks go to zero, but most of the gains we see over the long haul come about from a handful of stocks, from 1 or 2% of the stocks that are out there. And what are the odds that you're going to pick that 1 in 50 stock that's going to derive all the value and own it in a substantial enough percentage of your portfolio, meaning you're not going to own a whole bunch of other also rans. The beauty that Jack Bogle discovered, and that this is what's been driving Vanguard to $11 trillion in assets and BlackRock to $12 trillion, and maybe both of those are a little higher now, is that if we have a market cap based stocks, we own more of the winners as they do better and less of the losers as they do worse. And that's why it's so hard to beat the index. The data is in any given year, less than half of the active managers outperform the index net of fees and taxes. You take that to 5 years, it's 20%. You take it to 10 years, it's 10%. And you take it to 20 years, and it's a handful of people. Will Danoff of Fidelity kind of announced that he's retiring this year. He's run the Contra Fund, and he's had an amazing track record for 35 years. It's him. It's Warren Buffett. It's Peter Lynch. It's a handful of rock stars whose names we know. Renaissance Technology, D.E. Shaw. Not many more than that have consistently outperformed over time. It's very, very hard.
Yeah, and I think that a lot of people don't realize that. I've seen people with 67 stocks in a portfolio, 70 stocks in a portfolio, just buying random things.
How about 30 different mutual funds that all more or less own the same thing? I love when those come in. It's like you realize that you're just buying the same stuff over and over again.
Yeah, the correlations that are inside of that portfolio. And it's something that you kind of realize that, wow, the market is not that really diversified after all when you really look at it. So when people are like, hey, I want to pick, this is the hot, it's hard to do. And not only, I know you mentioned this in your book as well. And my father-in-law would say this, hey, I had an opportunity to buy Apple back in the 80s. I should have bought it. But what is the likelihood if you would have bought it that you would have held on to it through all the bankruptcies and the ups and the downs? Apple wasn't always a beautiful company. So I'm like, as soon as it probably would have made 50%, you would have sold it. So
until Microsoft rescued them in 98, they were going belly up. Microsoft, which was under antitrust investigation, said, hey, this is the only credible operating system aside from ours. We better do something to save them. Otherwise, once we're the only game in town, we're going to lose the antitrust case. So you had to not only hold on, and I don't know if it's in the book or if it's in the sequel, which isn't going to be out for years, no, it's in this book, the story about the guy who was the co-founder with Steve Jobs and Steve Wozniak, who sold his 20% or 30% of Apple for $800. Hey, don't take this the wrong way, but today that's worth $1 trillion. Wow. Not a good sale.
And for everybody, some of the comments that are coming in, they say, yes, exactly, a handful of stocks. Someone on LinkedIn says, hello, I'm checking in from Southern Mississippi.
Chilly.
Yep, loving the insight. Definitely have to catch the playback. So some of this I want to get into, right? These are some of the people that's been on my show too. That when I saw it, I thought it was kind of funny. You kind of ripped some people, some new ones, and you didn't talk around it. You called their names, you pointed out their tweets. I was like, man, Barry, he's not doing the subliminals. He's like, hey, check this guy out. The Big Short, Rich Dad Poor Dad, Robert Kiyosaki, rich authors, poor readers. Explain that, and it kind of ties into what you're saying about what they're selling. But looking at these rich authors, people who become rich, but you got poor readers. Explain that, because you took some big shots, Barry.
So the people who are great investors but talk about the next crash or the next recession, Sam Zell was a legendary real estate investor, but he was a terrible economist. He was an economist. He was not an economist, but he was constantly making economic forecasts. So first chapter, the reason I used him as an example, because you see a guy who's a billionaire, one of the most successful real estate investors, and he's calling for a recession or even worse in the summer of 2008, saying, no, everything's fine. There's no balance sheets are fine. There's no problem with real estate. We tend to believe people like that because they're so successful elsewhere. So the halo effect is we believe people we probably shouldn't. Michael Burry is a legendary investor. Guy has made so much money, not only during The Big Short, which is a fabulous Michael Lewis book, but also in the 15 years since then. Now, the problem with Michael Burry is his Twitter account, he's always forecasting the end of the world. But probably the worst of all of these people, because at least those guys have demonstrated, hey, we know how to make money either in the market or in real estate or whatever. And so if you pay attention to what we're saying about the specific trades or the specific, Sam Zell legendarily called himself the grave dancer. I made my money by buying real estate, quality real estate that was usually hugely distressed from people who were in financial trouble. All right, that sounds better than betting on the next recession. Burry also identified all these asymmetrical risks. Hey, there's a little bit of upside in subprime housing, but there's a ton of downside. That sort of analysis is really compelling, not just market crash, but Kiyosaki, somebody else. So Ben Carlson in my office had done a blog post titled Rich Author, Poor Readers, and we started chatting about it. And it's like, I don't really understand, what is this guy's story? And his answer was, he's been a catastrophist since 2009. And, the S&P bottomed at 666. We just crossed 7,000 yesterday. So effectively, we're 10x since then. And he has been nothing but bearish since then. My favorite bearish mention from him was in 2018. He was calling for another real estate crash. Have you priced houses in America recently? 2018 could have been the best time to buy, other than the financial crisis when everything went on sale, but you couldn't get a mortgage. 2018 was probably your single best time to buy housing with mortgage rates at 3 or 4%. If you listen to him, you're totally screwed. And so, look, he is literally the best-selling financial author of all time. You could look at Michael Lewis, but he writes very different types of books that are also much better and much more interesting. Even Morgan Housel's book, I think it's coming up on 10 million sales, The Psychology of Money. And he's not a guy who says sell, get out of everything. Yeah, that's a very fun book. I really enjoyed that. But the Kiyosaki book, it did so well, and it gave him so much credibility. Again, he's an author. He's not really an investor, at least not like Sam Zell or Michael Burry. And so when you have a really successful person who doesn't manage money, but is very public about, scaring people out of housing, out of stocks, out of everything. Listen, I'm not the world's biggest crypto fan. But in 2018, when he said there'll be a chance to buy all this back cheaper, sell real estate, sell stocks, sell bonds, sell crypto, I don't think he did anybody a favor.
Wow. Now that is very, I saw that, and you were very live and direct. And you went back to every tweet, you put it on the chart, and you was pretty much saying how just because somebody's successful in something doesn't mean they're going to be successful in everything. And you made mentions of that, and you went into the book to say, hey, this person has said the doom and gloom. Hey, get out of this. This is going to be terrible. This is terrible. This is terrible. And look what it, over time, these people were wrong. But when they are right, because one day, when we have when we have that bear come in, you'll see all these geniuses that will appear. Now, you made up a very good point. In the age of social media, you even put TikTok in your book. Okay? So,
the worst.
I spent a lot of time in this book. You got a lot of stains on it, too. You got a lot of coffee. It flew all over the country, a lot of airplane flights. But a point that you made here, what are they selling? When you hear influential people, people like myself who may be on social media, writing, whatever the case may be, you made a very good point to ask yourself, what is this person selling? Some people are selling courses. Some people are selling mutual funds or whatever. Why is that so important to listen to what somebody's selling?
So you got to know what is their motivation. And I disclose my motivation. I say, listen, I run an asset management firm. We have 5,000 clients and $7 billion, almost $8 billion. I want you to be a client.
Well, you said that so easy and so nonchalant, being like, oh, just $7 billion. So,
well, it's been more than a day. I got 20 something years on you, so I got a huge head start.
Yeah.
And I work with some great people. So, it's been, this didn't happen overnight. This took, a long, long time. But not only do I want people's business, but I want them to read my blog, buy my book, listen to my podcast. Like, that's my disclosure. Here's what I'm selling. When other people come to you and they don't tell you what they're selling, well, you got to look for it. So when folks go on TV and they say, I really think this sector is the next one to get hot, and I really think this is the next stock, well, my assumption has become they're already long that position. They want to see it go up. Maybe they have banking business. Maybe they're doing a syndicate, an IPO, a merger, whatever, but they're not an objective party. You have to look at people's track record. Who are they? What's in it for them? And remember, there's opportunity cost. If I buy stock ABC, it means I'm not buying stock XYZ because I only have a finite. It doesn't matter if it's $1 million, $1 billion, $100 billion. You only have so much money, and everything you put to work means you're not. When you buy this, you can't buy that. Money is finite. And so always ask yourself, what's the sales pitch? You would be surprised how often, and remember, human beings are social primates. You grow up in a group. There's safety in numbers. Cooperation is approved. We have a tendency to be very accommodating, not very suspicious, especially if someone seems like they're a decent person and they're a member of our tribe. So whether it's finance or, oh, you went to this school, I went to this school. Oh, you're a tennis player, I'm a tennis. Whatever it is they can do to make you believe you're part of the same tribe, well, you're more likely to buy what they're selling. And again, I'm saying I'm selling something. And if you at least know what I'm selling, you're in a position to judge it better. the folks who are selling stuff that you don't understand. And for me, I always thought the fiduciary side of the street was the only place to be. It never made sense to me that, wait, my doctor has a Hippocratic oath to put my needs first. My lawyer, I'm a fiduciary, the accountant, the tax guy. Why should the person managing all your money have the same relationship as a guy selling you a used Honda? That doesn't make any sense to me. It should be more like, is your financial advisor more like your accountant, tax guy, attorney, doctor, or more like the guy at the local Toyota dealership? It never made sense to me. So having that disclosure, having that, understand everybody's obligation and who they're out for is really important. By the way, our business model from day one has always been, hey, here's a lot of content that shows you could do this yourself. You don't need to hire me. You don't need to hire Prince. You could go do this yourself. And you have to be a little bit of work and a lot of self-discipline and managing your own behavior. And by the way, 0.01% of you don't want to do it yourself. You want to pay somebody to do it. Happy to have that conversation with you. So that's kind of been our model.
And I saw that in your book, and I really like that because I think when you're upfront with people, that's something that I do. Like, hey, do it yourself. I can show you to do it yourself. You can just blah, 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 blah. But I'm not going to hold your hand to do it because, I have other things to work on. But if and I like that because people really enjoy and like what you're saying and doing, because it's upfront. And I think that builds trust. Now, another hot thing, I didn't mean to cut you off there. Another hot thing too. Gold, silver, real estate versus general markets. Gold and silver the last couple of years has been hit on a tear. People saying, hey, uncertain times. What do you got to say about that? Stock, gold, silver, and real estate. And to cut off that last conversation, I want my listeners and people that follow and listen to this podcast to listen to when people come across, find out what they're selling, what are their commissions, and are they being upfront with you, letting you know, hey, this is what I'm selling, and this is a way you can avoid fees and do it yourself. But if you want to do it, I can do it. So
right
now,
stocks versus gold, silver, and real estate. They're three very different assets. So first, real estate, very different than stocks. If you have a lot of capital and you own real estate, there's all these tax advantages. And although now used to be 531 exchanges, we can now do that with equity. Like you sell a real estate, you get an in-kind, you could roll it into another piece of real estate and not necessarily owe taxes on it. Real estate, especially in a country like the United States where they're not making any more of it, meaning land, and a lot of the most desirable places to live very much have a NIMBY sort of attitude where there are a lot of restrictions on building. Real estate, you got to live somewhere. I still like the idea, and maybe this is generational, I like the idea of owning my own house. This way a landlord can never tell me I can't paint the walls this color or my lease is going up this month. I want to, for people who have young kids, I don't have young kids in the house, but for people who have young kids, you want to select the school district you're in. Typically, the more expensive neighborhoods are that way because they have better schools. So real estate is its own specific thing. Gold and silver, I always thought of gold. If you look at the history of gold, it goes through long periods of booms and long periods of busts. So if you're a trader, if that's your headspace, you should really think about, hey, look at gold, look how it trends. Take a look at Michael Koval's book, Trend Trading. He's trend following. He's the guy that's probably done more to help commodities traders have a book that's their version of here's the fundamentals of commodities and the risks. But it's not, gold doesn't produce dividend. It doesn't produce a yield. its value is what the collective group says it is. Silver at least has some industrial use. Like there's a little bit of silver in every solar panel, and silver has some application besides its use as a precious metal. But it's the same thing. Gold and silver or oil or any of the commodities really is a bet to some degree on the US dollar. So stop and think about this. Last year, the dollar was down about 9.2%. The last time, and it was down against every major currency, some of them really substantially. The last time the dollar was down this much was also first year of Trump's first presidency, 2017. And so I'm going to engage in what I just said is so problematic. I didn't forecast the dollar coming down. I don't do forecasts, but what we saw when we looked at flows, when we looked at all these different things last year, a substantial percentage of America's trading partners and strategic partners said, we're not thrilled what's going on with these tariffs. We're not thrilled with what we're seeing over there. We have a ton of ton of U.S. assets we own. We own a lot of stocks, a lot of treasuries, a lot of corporate bonds. We're going to sell some of that stuff, convert the dollars into our currency, meaning sell dollars and buy yen, or sell dollars and buy euro, or sell dollars and buy pounds, or whatever it is, and bring that money back home. And so what drives U.S. stocks are primarily profits, and the U.S. stock market profits have been record setting every quarter for 12 or 14 quarters in a row. So the U.S. market was up 17%, but the rest of the world was up 25, 30, 35%. So the U.S. kind of underperformed last year, and you saw that in the dollar. And remember, the dollar is the world's reserve currency. Commodities are measured in dollars. So when the dollar goes down, commodities go up. And so when we see gold and silver, or oil for that matter, when we see them going up, it very often, sometimes it's supply and demand issues like oil. Much of the time, it's a dollar issue. And that's what we're seeing in precious metals. It's kind of a vote about how our partners feel on the stability and the policies that we've seen. And, whenever I talk about this, I get, oh, well, you're just being partisan and political. No, I'm not. The dollar down 9.2% last year, 9.9% in 2017. Anytime you see the dollar fall that much, you're going to see gold. And when gold goes up, go up. And when gold goes up, silver usually follows. Stocks, on the other hand, you're making a bet on the ingenuity of human creativity, on corporate America's profits, and you're betting on, most of the top 100 companies, at least in the S&P 500, are hugely exposed overseas. The total S&P 500, almost 50% of the revenues are not U.S. They're outside. So you're making a bet on the whole world when you buy the S&P 500. But I suspect the dollar is part of the reason why the U.S. stock market didn't perform as well as the overseas stock market.
Okay. Now, another part you brought up about the numbers we watch. We turn around every day, we see Uber is laying off 500 people. UPS is laying off. Amazon is laying off. All the layoffs happen all over the country. And it's just not the labor market. It's just all statistical data. Denominator blindness. You spoke about this where, hey, you're saying UPS is laying off 40,000 people. And we all say, 40,000 people? Oh, my God. And you, in the denominator blindness, you said, hey, nobody talked about how many people they hired. How many people do they employ? How big is that? You might realize they might employ 1 million people. So 40,000 is, nothing. So denominator blindness, because the headlines, you spoke about 24-hour financial news. We got to have something to shock people to make them want to watch. So these numbers is what made people go, tune into things. But as an analyst of watching these numbers, the denominator blindness, can you break that down for us?
Sure. So my favorite example of that is Walmart. Walmart's laying off 10,000 people. Oh my God, 10,000 people. Yeah, they have They have 3,000 stores. They employ 3 million people. A 10,000 person layoff means one person every fifth store is leaving Walmart. By the way, that happens Monday morning by 9 a.m. One person every fifth store leaves. The big retailers always have issues with turnover. The really interesting, there are some really fun ways to demonstrate denominator blindness. The selfie deaths was probably my favorite one. So Outdoor Magazine ran a story that there was like, I don't remember the numbers, but it was a few hundred selfie deaths over the past 8 years. And they explained we had these selfie deaths in India and here in the United States and here, like all over the world. Outdoor Magazine. And, it sounds like, oh my God, this is really a problem, until you stop and say, how many selfies are taken a year, and how many, what sort of risk does taking a selfie put you at? And so there was a Google developer conference in like 2015 that said there were 93 million selfies taken a day. So that's Google. It's not even including Apple. So you do the math, and it's like a gajillion selfies a year. And over the period of time that these selfie deaths happened, it like, unless you're engaging in the most risky of behaviors, right? So if you're going to go on a train track, an elevated train track, sort of like if you remember the movie Stand By Me, where, if a train's coming, you're screwed. If you're going to go up there and take a selfie, well, that's just really stupid. What does that have to do with the person who's at a dinner in a restaurant and they're taking a selfie of them and the rest of the table? It's like, and it's the same thing with shark attacks. Every summer, everybody runs these stories about shark attacks. You always see these stories. There's 5 shark attacks, 10 shark attacks a year, and 2 or 3 or 4 deaths around the world, 8 billion people. Everybody freaks out over this. It's like the odds of you, especially if you don't live by an ocean, well, really, you shouldn't worry about shark attacks. And if you do live by an ocean, you shouldn't worry about shark attacks either. There's 3 or 4 or 5 attacks a year. What are you stressing about? It's so silly. And that's denominator blindness, where, look, sharks and terrorism are not what's likely to kill you. What's going to kill you is heart disease, diabetes, high blood pressure, cancer. You never really see that on the front page of the newspaper because it's an everyday event. And the parallel to our portfolios, everybody's freaked out about market crashes and hyperinflation and whatever. That's not what kills portfolios. What kills portfolio are excess turnover, high fees, paying a lot of taxes, over trading, lack of diversification. The things that kill portfolios, they're more akin to high blood pressure or diabetes and less like shark attacks and terrorist attacks. But that doesn't get, the headlines.
It was funny because you mentioned that about planes. When a plane crash happened, or 2 plane crashes happen, everybody's like, oh my God, what is going on with these planes? I don't want to fly. And you're saying, hey, yes, maybe 5 flights have crashed, but you're not talking about the 5,000 flights that fly per day. So everybody talks about that number, but they don't contextualize the entire argument of how many people or what is being impacted.
Let me give you the craziest flying stat. Aside from the fact that the industry is just constantly improved. We talk about the black box. It's improved so much that it's actually orange because they discovered that if it falls into heavy brush or underwater, orange is easier to see than a darker color. But here's my favorite, craziest stat. I think it was the Planck Institute in Germany. So following September 11th and the terrorist attacks in New York and D.C., they tracked over the next 5 years the amount of flying and the amount of driving compared to the benchmark, the previous baseline. And what they found is people were freaked out by 9/11, which is certainly understandable. But they drove so much more that in addition to the 3,000 deaths caused by 9/11, there were 3,000 additional deaths attributed to 5 years of that much additional driving. Look, in the United States, we have like 40,000 automobile deaths a year, which is a lot. Suicide is a higher number than that. But 40,000 deaths a year, the 5 years after 9/11, it was 5,000 over that. And it turns out the most dangerous part of your vacation isn't your flight to wherever you're going. It's the cab to and from the airport. That's much more dangerous than your flight. I don't remember, it was 20, not counting the pandemic, but 2019 and then 2022 and 2023. In the United States, there were 0 commercial aviation deaths. That's how good the industry has gotten. And the big takeaway is when you are extremely honest with yourself and you are constantly trying to improve and you are constantly looking at what you've done wrong and finding ways to be wrong less frequently, how not to fly, the industry gets better. And you compare that to the healthcare industry, where accidental deaths are still, medical mistakes and things. That's a real thing. That's a measurable thing. And the healthcare industry is so paranoid about government regulation or litigation. They're very closed. After a plane crash, there is like a 2-year investigation, and they go through everything and they look at all the data. Everybody involved is mandated to turn everything over, and we figure out ways to make things better. Not counting the recent Boeing snafu with their latest plane, which was really their own bad judgment on changing the model of how they build planes. But generally speaking, when we look at commercial aviation, it has just gotten safer and safer and safer.
Now I got to get into this question because you did a myth buster. You had a lot of myth busters in this book. So everybody that's out here who's watching this, who's catching the playback, who's seeing it live, we're definitely seeing your comments here. They said on LinkedIn, sounds like a common issue. Readers trusting authors but not verifying the author's opinion. Someone says here, The Psychology of Money is on my list of books to read this year. Facebook says great conversation. Jamisha, it says 99% don't want to do it themselves. Don't want to do it by myself. Don't want to do it myself. But I have this question. So people that says, hey, I want to do this myself, and I watch all the commercials, and I've seen a ton of people on YouTube. They tell me about this thing called day trading. And how do you feel about people that are like, hey, there's a plethora of courses, books, tell me, hey, I can day trade and get into this, take my 401k, day trade it myself. I know you're going to get into the tax piece. How do you feel about that with people saying, I'm going to do it myself? Right there.
Right. I mean, just because professional money managers that have all got MBAs, taken all the courses, started working at big firms with every tool and every piece of technology to their advantage can't do it. Sure. Open up a Schwab or an E-Trade account, knock yourself out. The reality is it's really hard. Even if you're not succumbing to all of the human cognitive errors, even if you don't get in your own way, there's 500 stocks in the S&P 500. There's about 3,500 stocks in the Wilshire 5000. A bunch of stocks have merged and this and that, so it's not 5,000. Which of those stocks are you going to buy? What's your basis for selecting a stock? What's your percentage of your portfolio that's going to be in it? What's your risk management like? How do you determine, when you sell that stock? Don't get me wrong. I started on a trading desk. I love trading. I'm always looking for a vein, and I want that dopamine hit. The problem is, and I did that for a couple of years, and my wife one day said to me, hey, I don't understand. You're up 100 grand this month. You're down 50 grand the next month. Can you make a living doing this, or is it just random? And my answer was, kind of feels random, but it's a lot of fun. She's like, well, this is not what you're doing for fun. This is what you're doing to earn a living. And I was really lucky in the mid 90s when I started on a desk. There really wasn't such a people didn't understand behavioral economics, behavioral finance. It wasn't until 2002 that Danny Kahneman won the Nobel Prize in economics, which is kind of interesting because him and his partner were both psychologists, Danny Kahneman and Amos Tversky. But I was kind of fascinated while you're on a long desk with all these guys trading. Some are executing orders for clients or for the firm, but you have the opportunity to, when you see an opportunity come along that you can make money, everybody gets a line of credit as they demonstrate the ability to trade successfully. And, some of these guys were making a ton of money. But the thing that always blew my mind is Shecky sitting on my left is killing it this month. Just like whatever he does turns to gold. Mitchell on my right is just getting slaughtered. Whatever he touches, just garbage. And then a week later, now Shecky is getting killed and Mitchell is making money. And I, as a newbie trader, was trying to figure out what's going on. And eventually, and I'm reading all these different books. And let me give a shout out to Market Wizards by Jack Schwager, especially the first one. He talks about bond traders, stock traders, options, commodities, futures, like all these different types of traders. And it really turns out that it's all about discipline, having a plan, and staying with it. Most of us are really bad at that. We really are. So I kind of fell down the behavioral finance rabbit hole. The next book I read along those lines, everybody should read Reminiscences of a Stock Operator, which is similar. There was a book which is a little more academic called by Cornell professor named Thomas Gilovich, How We Know It Isn't So. And it turns out most of the stuff we believe is kind of nonsense. So a lot of the myth busting you talk about is because first of all, a lot of what we believe is nonsense. Second, we have way too much confidence, especially men have way too much confidence relative to the skill set. And so the whole section on Dunning-Kruger or epistemic trespass is about how hard can it be? I'm pretty good at math and I understand computers. How hard can trading be? And the answer turns out to be really, really, really hard. Somebody is going to be a rock star. If you put 3 million people on trading desks, eventually you're left with a handful of people that are just killing it. It's hard to tell if they're lucky or consistently skillful. There are some hedge funds that consistently make money, consistently. Quant funds and some people who identify these little, I'm friendly with Boaz Weinstein, who runs a hedge fund. One of his funds looks at these closed-end funds that are trading at a discount to net asset value. It's like, wait, how is that possible? Shouldn't the market have clarified that? He actually set up an ETF, closed-end funds, CEFS, because if you can buy $1 for 80 cents, well, you're going to make money. It's kind of hard not to make money. But trading is really hard. It's really hard. One of the things I recommend in the book to avoid letting your main money succumb to this is, okay, take 2 or 3 or 4% of your liquid net worth and put it into a cowboy account. And if you want to have fun with it, well, go at it. If it blows up and goes to zero, thank goodness it wasn't your real money. But if you do really well with it, don't imagine that you could do that with your full portfolio because, like you said about Apple or Google or Amazon, if you're in those companies and they're up 2x, 3x, I tell the story in the book about some of my dumbest trades ever. When I was at a brokerage firm in the early 2000s, and I was a big Mac guy, I got to see the very first Apple iPod. I went to the, I got the notice about it, and I'm like, oh, I'm traveling. Can you send me a demo example? And so I got my hands on the demo copy of the iPod. I want to say it was like 02 or 03. At the time, Apple was $15 with $13 cash. So what are you risking? You're risking $2. So I recommend it to the firm. All the brokers bought it at 15. It goes to 20, and they all sold it. And I'm like, what are you guys doing? And they're like, got to ring the bell, got to drop a ticket, got to get paid this month. So just to demonstrate to them how terrible of a trade it was, I held my personal Apple till it was a triple, went to 45. And then I'm like, LOL, you guys made 33%. I made, 10x that. I made tripled my money. And from there, Apple went up another 10,000%. So it just goes to show you, even getting it right, you're not going to get it right. Because, oh my God, every time I spoke to a guy who sold it at 20, and I'm still long it at 25 and 30 and 35, they all said the exact same thing. Hey, bulls and bears make money, but pigs get slaughtered. Right? How many times have you heard that? So it was triple, and I remember saying, now I can show these brokers you can't just take a small win on a really good company with very little risk. Terrible, terrible trade, right? I thought I was a rock star. It was the dumbest sell I've ever made. But it just goes to show you, even if you're right, it's so hard to stay long. Like, I know people who bought Amazon in 01, 02, single digits, and it went to $10, $12. They're like, I'm up 5X, I'm out. Okay. Nice trade.
Yep.
So that's the problem with day trading. It's not a career. There's a lot of to do it right, you have to set up a separate company. You have to make sure you have an accountant who understands how to deal with all these issues. It's a big pain in the neck. And we have this bias towards action. Don't just do something, sit there, does not resonate with people. And so in reality, if you go, like, I've counseled a lot of brokers and a lot of traders over the years, and I love to say, give me your trading blotter. I want to see all your trades. And so they're like, I don't understand. I'm killing it. I'm up 5X in this and 3X in that. How come my portfolios aren't doing well? All right, well, you own 47 different stocks, and this one is doing great, but you only have 3% of your portfolio in that, and the next one is doing pretty good. All right, that's a bigger position. But the next, if you only traded your best 3 or 4 ideas, you would be killing it. But that's not what you do. You're trading a different bullshit idea every week and holding on to these things. There's something to be said for the practice on a trading desk of, if you're in something, so there's a big difference between trading and investing. As a trader, something goes up, you buy more of it, and something starts going down and you're out immediately. Risk management is really, really important. So on a trading desk, you could be in the same stock 3 times. I bought this at 10. I'm out at 9.50. I'm in it at 10 and a quarter. I'm out at 9.75. I'm in it at 10. Oh, I'm adding at 11, 11.50, 12, 12.50, 13, 14, 15. All right, 16 it topped. It's heading down. I'm out. Like, that's how traders operate and think. It's not the home runs, and it's not necessarily your percentage winners and losers. It's how much you manage your losses and how long you can let your winners run. And that's a really counterintuitive way to operate. It's very hard. It requires a lot of discipline. And it's as much as, having that dopamine hit is a ton of fun. It's like, I don't know if you play poker. If you play poker right, it's boring as hell, because you're really not playing every hand. You're only playing the good hands. And God damn it, I played poker in college. Doing it right was boring as hell. And the same is true about trading. It's exciting and fun. If you're trading and having a lot of excitement, a lot of fun, probably means you're doing it wrong.
Okay. Now, I got this question. Would you rather ride the bull or prepare for the bear?
I think you got to do both. I think they're two sides of the same coin. And here's some really crazy math. I find this fascinating. If you dollar cost average and pick whatever bear market you want, 1966 to 1982, 2000 to 2013, you feel like an idiot for 10 years. Like I'm buying into 01, 02, going lower and lower to March 03. Wait, I'm buying from 07 into 08 into, this just feels terrible. But when you come out of the bear market, and I have a section in the book on long-term secular bulls and bears. So 1946 to 1966, the market went up huge. 66 to 82, 16 years, you're going sideways. That's before inflation. For inflation, you're down 75%. 82 to 2000, you're up 1,000% over that period. And then, if you bought everything at the peak in 2000, if you bought the Dow, the NASDAQ, the S&P, the Russell 2000, they weren't over those highs other than really briefly in 07, but they didn't permanently get over those highs until March 2013. And so whatever you're buying during that period sucks. It just feels awful. So there's a bear market out there. I can't tell you if it starts in 2032 or Monday, but somewhere in between that period is a bear market. And the next 6, 8, however many years, it's going to suck. Dollar cost averaging is going to be painful and uncomfortable. And you're going to say to yourself, why am I doing this? I should be speculating in this or buying that. And when you come out of the other end of it, perfect example, from March 2009 to yesterday, the S&P 500 is up more than 10x. And that's what it's like if you're buying during a bear market. By the way, the average return is about 10% over 100 years. But that's over 100 years. In any given year, the average return is almost never 10%. When it's down, it's usually down single digits, 4, 5, 6%. Like 08 is an unusual year down 38%. Or up, what we've seen is, think about 96 through 2000. They were all double digits, 96, 97, 98, 99, all up double digits. Look at the past 3 years, 17%, 24%, 25%. Before that, down 22%. Before that, up, 20? From the lows was up 69%. I think overall we were up about 28% for the year. So when you have a positive, and these numbers, I'm just doing them off the top of my head. I'm sure half of them are wrong. But when you have a positive string of numbers, they tend not to be the average 10%. They tend to be much more than that.
Wow. Okay. Because looking at it today, you say, hey, you got to do both. But if I'm today, if you was 41 years old, the 41-year-old Barry, would you be on that bull, or you would be waiting for the bear, sitting in cash, buying gold? What would the 41-year-old Barry be doing right now?
So I know how everything turned out. So let's deal, rather than me, cheating. Let's deal with the 41-year-old Prince. That I don't know how long you plan on working. I'm planning on working. I don't know if I'll go as far as Warren Buffett till I'm 95, but I certainly want to work another 10 or 15 years. So let's assume you're going to work till 60, 65, 70. You have 20, 25, 30 years to go. Over the course of those 30 years, you're going to see the markets up much more than they're down. They're up 3 out of every 4 years. So for you, even after this 15-year run, we've had a fantastic 15-year run. I'm going to say I want to be a bull, not a bear. And I am telling you, there is a bear market coming. It's out there. I wish I could give you the exact date. February 3rd at 12:43.
If you find out, please let me know.
Now, that said, if you're diversified, if you have a mix of U.S. and international, if you own a little bit of real estate and a little bit of this and a little bit of that, the old joke is being diversified means you always have something to apologize for in your portfolio. You'll be okay. So instead of being down 56% like the S&P during the financial crisis, or 83% like the NASDAQ 100 during the dot-com crisis, you'll effectively be able to ride it out. You just have to know somewhere out there. Listen, January 2022, that year, nobody had Fed raising rates 500 basis points, and the stocks and bonds both falling double digits. The S&P down 21%, bonds down 15%. But, that was just 1 year in the middle of a lot of good years. There's going to be a bear market out there somewhere, and it's going to suck for 5 or 10 years. And again, I don't know when this happens. I think it'll happen when either the New York Knicks or the New York Giants win the championship. That's one of the 4 horsemen of the apocalypse. That's how we'll know something bad's about to happen. But somewhere out there is this bear market, and you're going to have to ride it out. And more importantly, you're going to have your clients ride it out, because it's important that for whatever they're investing for, especially if you marry their portfolio to a financial plan, that's the upside for them.
Yeah, that's that's one of the hard things where that bear is out there and you don't know when it's coming. It's like a hurricane, but you don't know when it's coming. But it's out there and it's going to come and it's going to suck. But you don't know. It may happen tomorrow. It may happen 5 years from now, 10 years, 1 year. So, because if you overly prepare, like you were stating earlier, it's always a reason to sell. All the different crashes. If you over prepare, you could miss out on 1, 2, 3, 4, 5 years of a bull.
That's exactly right. Plus, if you're dollar cost averaging into the top and you spend a couple of years wandering in the desert after the crash, when you come out of it, you end up owning stuff at a much more attractive basis. Ben Carlson did a post about the world's best market timer, and also referenced in the book. And he just shows that even if you get it right, you're just better off dollar cost averaging. And that's assuming you don't engage in any bad behavior. And a lot of us, we can't help it. We engage in bad behavior.
Now, the last topic before we roll out of here, we touched around a lot of it. Barry, you've been around. You've seen everything. You wrote the book. The common mistakes by investors. You have a lot of mid-grade investors out here who's watching this, who will watch this, who's hearing this. Give me some of those common mistakes that you see across the board.
Sure. So I always tell people, if you want to be a stock picker or you want to own, hey, I want to own a little Japan or a little India or whatever, well, start with a core of, if you're chasing alpha, you're probably not going to get beta. Meaning, if you're trying to do better than the market, the odds are you're going to do worse than the market. So at the very least, start with the core of beta, meaning 50, 60, 70% broad index. And then however you want to decorate the Christmas tree, knock yourself out. But the tree itself should be, a broad index. So that's number one. Number two, if you work with somebody, make sure they're a fiduciary. Make sure they're not the guy selling you a used car, but they're more like your doctor, lawyer, accountant, tax attorney. And they're legally obligated to put your interests first. And then third, you always have to watch fees. You always have to watch taxes. And perhaps the most important thing. So one of the people
I want to bring this one up. Someone, I didn't mean to cut you off there. I managed my portfolio for 4 years and realized I have a low tolerance for risk. The last 2 years, I tested a few investment firms and landed at one that outperformed my profits even after deducting the management fees. Well, would you want to add anything to that, Barry?
So there are a lot of studies that have shown that your generation and younger are shockingly risk averse. Why is that? So you're born in 86, right? 84. All right. So you're born in 84. So real estate had a little bit of a peak and a pullback in the 90s, because stock market was doing so well. By the time you're thinking about college, you're looking at the dot-coms imploding. By the time you're in the job market, you're dealing with the financial crisis. There's a shortage of affordable housing. Mortgage rates are hard to get a good mortgage these days. And so there's an entire generation of investors that have been scarred by these experiences, and they tend to be very risk averse,
Yeah,
right?
we went through a lot. We went through we saw the dot-com bomb. We saw '08 real estate. So we saw the NASDAQ get crushed. We saw real estate
Pandemic.
get crushed, pandemic. So our generation got a lot of PTSD going on, financial PTSD.
So,
So
so when someone says, I'm a little risk averse, I always point to them, hey, that's totally understandable. Look what you've been through. But here's what we've seen. We see people my age, plus or minus 5 years, they're a lot of equity exposure, carrying very little cash. And we see like millennials, Gen Z, Gen X, they're like 30, 40, 50% cash. Cash doesn't get you anything. And while it's important to have a little bit of a savings tied up in case anybody loses their job, when you have a 30, 40-year time horizon, it's hard to find a better long-term track record than equities. So cash today generates 3% if you're in a money market fund, and you owe taxes on that. So you're anytime I see someone say, "Yeah, I'm not maxing out my 401k," okay, you don't want that 3 or 4% free money match. It doesn't make any sense to me. So I tell people you have to manage your behavior. You have to manage that risk aversion, especially if you're saving for retirement and you're 40, you got 25 years. Let it roll.
okay, yeah, because we saw, through your book. I mean, the first couple of chapters when you guys going to see the link in here to the book. And I know most of you guys, I didn't give y'all the whole bio of Barry, but you already know who he is. He doesn't need an introduction. I don't need to go down his whole track record. If you haven't done, just do yourself a favor and do a little Googling, and you'll figure out who he is and, things like that. But I love to talk to people like you who've been down that path, who've seen so much, because we were reading about '08. You lived '08, you was there in the belly of the beast. Whereas in my era, we were like early 20s, maybe. And we were afraid. Then we saw the pandemic, then we saw people lose their houses. So we don't really trust real estate. Then we saw the stock market crash. We don't really trust that either. So we're kind of all over the place where we have PTSD when we come out to the world of investing.
Yeah, the pandemic was over before it started from a stock market perspective.
Yeah.
What was it from middle of February till the end of March? It's like 5 or 6 weeks. It came and went. When I was a kid, I have just the vaguest awareness of what happened in the 70s, but oil prices spiked, inflation much worse than what we experienced in 2021 and 2022. I mean, it was persistent because not only was there high inflation, but lots of people were getting laid off. Unemployment rate was high. So, we made a conscious choice during the pandemic. We're going to do the biggest fiscal stimulus since World War II as a percentage of GDP. And it's probably going to cause a lot of inflation, which will be temporary, but it's better than causing this giant set of layoffs and sending unemployment up to 10%, because that's scarring and that lasts a long time. Now, it turns out inflation has its own issues. But I think if you ask most people, what are you more afraid of? A temporary spike to 10% in inflation or a temporary spike to 10% in unemployment? Unemployment is horrifying. It's like suddenly not only did you lose your job, it's really hard to get a job. So inflation almost doesn't matter if you're unemployed and broke, right? So that was a conscious choice the government made, and under the Trump administration, and I think that was the right choice. Hey, let's get money into people's hands, let's keep them at home, and let's get a vaccine out there as fast as possible. And it's easy after the fact to look back with hindsight and say, here's what we should have done. It's like, well, you should have bought Amazon when it was 4. You don't get to go back in time and do that. You make the best decisions you have about an inherently unknown and unknowable future with the limited information you have. And that's why looking at these things probabilistically is, I think, the better way to go, rather than saying, here's where I think the Fed's going to cut, and here's what's going to happen with bonds, here's what's going to happen with stock. Like, maybe you're right, maybe you're not. I would rather say, well, here's what stocks have done over 10 years, and here's what bonds have done, and here's what commodities have done. And so that's how I'm going to create my portfolio, not for just one possible outcome, but here's the best case scenario, here's the worst case scenario, here are all the things in the middle, because I don't know what's going to happen next. And the only difference between me and most of the guys you see on Bloomberg or CNBC is I'm telling you the truth and they're guessing and not admitting it.
Yeah, now, and the thing about it is the power of I don't know. That's what me at 41, how I look at the world of investing is my brain won't even allow me. My military service from 2003 to 2023. I tell people all the time, 2000, from the day I walked into the military to the day I retired, that 20-year span, the S&P 500 did like 400%, right? We didn't know it. It didn't feel like it. I know that probably won't happen again, XYZ. But the thing is, but in that time period, so much drama happened. When I joined the military, was with Bush. We was at Obama 1, Obama 2, to Trump 1, to Biden 2. So, and it was my brain wasn't even allowed to know what happened on the daily. But with all of that crap, all of the crashes, all of the whatever that went on, you had gold spikes, silver spikes, markets crash, real estate boom, turmoil all over the world. If you just toned down that noise, you would have been better off. So that's something I employ now to say, hey, I can paint a pretty picture. In the next 5 years, I would bet the market's probably going to be better. But if you ask me the weather, what's going to happen in between, I have no idea. But it's very powerful to admit, I don't know. Go ahead, David.
Yeah. So there's a story I tell in the book about the founders of Netflix, which began as a DVD by mail. You would sign up online and create a queue, and there were no late fees. You would get a DVD in the mail, you'd watch it, and they'd send you those little red envelopes. That's why their logo is red. And when you were done, you'd mail it back, and the next video in your list would show up. And it was just DVDs all the time. And it was, I don't remember, it was 03 or 06, but sometime in the 2000s, they went to Blockbuster and said, why don't you guys buy us for $50 million? And at the time, Blockbuster had like 8,000 stores. And buy us for $50 million and we'll run your online business. And Blockbuster laughed them out of the office. So here we are. Netflix, I haven't looked at it recently, but they're a $400 billion company. Blockbuster, from 8,000 stores, at least at the time when I submitted the publication, there was one Blockbuster left
in Washington.
Yeah, somewhere in the Pacific Northwest. It's the last. It's the last one, and I can't figure out why they're still in business with.
It's a museum there. The lady who runs that literally goes to Walmart, buy DVDs, and put them there. And it's more like a touristy, like, wow, it's one, like, more than anything. Like, I think that's why it's in business, because ladies like, hey, we go to buy the DVDs and we put them on the shelf. It's like a blast from the 90s, essentially.
So think about that story when we're talking about I don't know.
Yep.
Not only was Blockbuster clueless about their coming demise, which they should have realized, hey, internet speeds are getting faster, broadband's getting faster. Eventually, no one's coming into our store. They're going to be doing this online. But stop and think about how foolish the Netflix founders were to say, yeah, give us $50 million. It's now, it's now $500 billion. So even the guys who got it right had no idea what the hell was coming out.
even the guys who knew that's a good point. Now, I do want, before we roll out of here, over at LinkedIn, Travis M says, I've settled with special CDs from Navy Federal. I know I want to get rich, but I feel as long as I'm not losing money, I'm making money and enjoy every penny the bank wants to give me. Now, something I'm reading this, I look at the opportunity cost. You might be earning 2%, great, but last year markets did 17%. And especially depending on your age, let's say if you're in your 30s or 40s or something like that, and it's great you're making money from CDs, but the opportunity cost. Well, I'm gonna let you go ahead and touch on that, Barry. What do you have to say to this?
Sure. So I don't know anything about this person. I'm
Yeah.
I'm actually looking up what the Schwab money market is these days. But all right. So Shivis, how old are you? What's your income? What's your tax circumstances to earn 3.5, 4% from Navy Federal? I'm not sure if that, especially if you're under 50, you're saving for retirement. Now it's different if you're saving. Let's say you're saving up for a down payment for a house, and it's money you can't lose. Well, then I would be very much in the camp of either very short-term treasuries, or if you're high income muni bonds, so you're not paying taxes, or a CD like this. And that really is a really really interesting way to look at this. But if you're saving for, well, think about your kid's college. You're going to set up a 529. It's not going to be in CDs. It's going to be in equity. And if you're saving for retirement, it's the same thing. You're looking for the sort of numbers that are going to compound over time ahead of inflation. So if you're getting 2 or 3% today on money market, and inflation is 2 or 3% today, I don't see how that's generating much of a return. You're a 0.5%, 1% ahead of inflation. That doesn't do it for you.
And Barry, you're speaking of real return, because
Yes.
we log in, we look at 3%. We're saying, great, I made 3%, but we didn't pay attention to what inflation was. And you're looking at, oh man, inflation was at 3% as well, or 2%, while I got 1%, and I'm 42, 41, 39, 38, 35, or 45 years old. And like you said, if you're looking to go to college next year, or saving up for a car, a vacation, makes sense. But if it's 5 years or more, I look at that and look at the opportunity cost of. And the big thing, Barry, people don't know how to benchmark their portfolio. They don't know what the benchmark is. That would change everything for me on knowing, oh, the benchmark is the S&P 500. This is what it is. This is what I can compare my investments to. And that's what changed everything for me. But Barry, thank you for your take on that. But before we get out of here, what do you want to leave the listeners and viewers with?
So of all the things I talk about in the book, there's a quote from William Bernstein, was a neurologist who became an asset manager. And he said the single most important thing is he talks about the limbic system, but I'll translate it into.
What is his name again?
William Bernstein. He wrote the 4 Pillars of Investing and A Splendid Exchange, and he's written a bunch of books. But
I got one of them on my shelf. I was looking for it, but go ahead.
So basically, he said your limbic system, which is your fight or flight response, like anytime you're stressed, you're dealing with the emotions of a down market or a drawdown. His answer is the single most important job for an investor is to manage their limbic system, to control their limbic system. Meaning your behavior. If you can't get your behavior under control, you will die poor. And that's like, here's a guy who not only knows the finance side of it, but he was a neurologist. He was a brain expert. And his takeaway is this is all about behavior. We focus on picking this stock, that bond, this thing, and it matters much less. And all the things we focus on are the things that are out of our control. What's the Fed going to do? How are earnings going to be? What's going on in Minneapolis? Hey, what's happening with Europe and Greenland? And none of that stuff is in your control. And it's what the media talks about 95% of the time. What's in your control? How much you're allocating to stocks, bonds, whatever. Do you have enough money saved up for an emergency? How are your fees? How are you managing taxes? Like, all of these things really make a substantial difference to how you're going to do, as well as your own behavior. Do you panic every time there's a 5% full out, or you just ride it out? If you get your behavior under control, which is within your ability, that's where all the upside is. So while we focus on everything else, stock picking and how much private equity should I have, and what about all the things that we obsess over, really it's managing our own behavior, controlling our ability to not make bad decisions, is the single most important factor that determines how financially successful you are over the long haul.
Okay, so Chambers Lim says he's 44 years old, retired Navy. Shout out to retired Navy. Collecting VA disability. I agree with everything you both are suggesting. I'm in CDs while I'm exploring other opportunities.
That's a very specific case. There's a very different, cash flow needs. That's a whole longer, that's a whole longer conversation. And that's important. It's really important to recognize that it's not one size fits all. You have to find the right fit, what you can live with. Like, great returns that are up and down and you're not sleeping at night isn't going to help either. Something like that, you really have to think about.
Okay. All right. Well, and one last thing, he says, great conversation. And if something was to happen to you today, knock on wood, could the people you leave behind understand your strategy?
Yeah, if I'm hit by a bus tomorrow, it's really simple. The core of our portfolio is a broad index, depending on. So if it's custodied at Schwab, it's mostly Vanguard and BlackRock stuff. If it's Fidelity, it's a lot of Fidelity stuff, like our 401k. But it's a core total market index. Some European stocks, some Japan stocks, meaning indexes, broad European, broad emerging market, broad small cap value. Those are the ornaments on the Christmas tree. But the bulk of it is really simple. It's really straightforward. It's here's the core with a little bit of our own stink on it. But, it almost doesn't matter. As long as you have a broad equity exposure via broad indexes, what you do around the edges, it's not that significant. You want to be exposed to the largest, fastest growing, most successful companies and be able to hold those over the long haul. And that's the key takeaway. So we are set up so that, anybody should be able to understand our process, our methodology. And, myself, my partners, Josh Brown, Michael Batnick, Ben Carlson, Blair, Tony Isola, all the different people who write at the firm, Nick Majuli, like, it's the same theme. It's keep it simple, understand how difficult it is to generate alpha, start with beta. If you want to add to that, you can, and just try to avoid the errors that undo all these investors.
Speaking of Nick, I got it. And when I was reading your book, I realized y'all knew each other. I'm like, oh, they know each other. So
yeah, our offices are this far apart.
So I will be reaching out to Nick as well to sit down and do a book review, because I did read his book as well.
That's his second book. His first book was Just Keep Buying, which gives you a sense of our philosophy.
Okay. Well, thank you. Well, how can people follow you, get more of you, your newsletter, your podcast, your
phone? So everything goes up at Ritholtz.com. You can sign up for my daily reading list. You can sign up to be updated whenever a new podcast drops. I do one Masters in Business a week for Bloomberg. It's kind of a who's who of people in finance. I've had, everybody from Danny Kahneman and Robert Schiller and Richard Thaler to Ray Dalio, Howard Marks, Jeff Gunlock. Go down the list. I've been doing it since 2014. So I've got 500-600 of them under my belt. After you get a few hundred behind you, you suck a lot less. You get better at it. And it's just, I like to say, it's the most fun I have all week. I get to sit down with these people and just pick their brains and ask the question, hey, how do I become a better investor? Like you're never done. You're always asking that.
Nice. Well, Barry, did you have a good time?
Yeah, absolutely. This was a lot of fun, Prince. I really appreciate it. It was fun meeting you at Future Proof in Huntington Beach. I'm looking forward to going back to Huntington Beach this September. It's always a big party. It's always a good time. And I get to meet people like you. So it's a blast.
Always good. And would you come back home if we want to?
Yeah, absolutely.
Okay. Well, definitely. All right, boys and girls, ladies and gentlemen, children of all ages, thank y'all for tuning in. I know y'all haven't seen me in a while do an interview, but this one was a special one. He pulled me out of retirement to come in and sit down. But as y'all can see, I've been reading a ton of books, and I'm going to be reaching out to some of my favorite authors that I saw and to bring this content to you guys and girls. Check out how not to invest, to get more contextualized of the conversation. And when I see you this year, I'm going to get you to sign my copy.
Absolutely.
So, yes. All right, ladies and gentlemen, we will see you on the flip side. Hit the subscribe button. Hit the bell icon. Hit that like, comment, and share button.